Most Americans don't think about the Federal Reserve, the Fed, in their daily lives, but its decisions ripple through everything from your savings account to your grocery bill. As the central bank of the United States, the Fed sets policies that can either stimulate the economy or cool it down, and that directly affects your wallet. Here are the top 10 ways the Fed influences your personal finances in 2025. 1. Interest rates on loans and credit cards. When the Fed raises or lowers the federal funds rate, it impacts the interest you pay on credit cards, car loans, personal loans, and mortgages. In 2025, even small rate changes can add up to hundreds or thousands of dollars annually, especially if you carry debt. 2. Mortgage rates and home buying power. Fed decisions influence long-term interest rates, including those for mortgages. When rates go up, your monthly mortgage payments rise, which can lower the amount you qualify to borrow. Lower rates, on the other hand, can make homeownership more affordable. 3. Savings account and CD yields. The Fed's actions affect what banks are willing to pay in interest on savings accounts and certificates of deposit, CDs. Higher rates mean better returns on your emergency fund or long-term savings, something savers are appreciating in 2025 after years of low yields. 4. Inflation and everyday expenses. The Fed's primary job is to keep inflation in check. When inflation runs too high, the Fed often hikes rates to cool spending. If it acts too late, you feel the pinch at the gas pump, grocery store, and in rent prices. Controlling inflation helps protect your purchasing power. 5. Investment returns. Stocks, bonds, and retirement accounts are all sensitive to Fed policy. Rate hikes often cause stock market volatility, while lower rates can fuel rallies. In 2025, smart investors are closely watching the Fed's signals before making major moves. 6. Employment opportunities. By influencing interest rates and overall economic activity, the Fed indirectly impacts the job market. Looser monetary policy typically leads to more hiring, while tighter policy can slow down job growth. Your job prospects can rise or fall based on what the Fed decides. 7. Student loan costs. While federal student loan rates are set by Congress, private student loan rates are tied to the Fed's benchmark rate. If the Fed raises rates, new borrowers might see higher costs. In 2025, refinancing decisions are heavily impacted by Fed actions. 8. Housing market conditions. Beyond mortgage rates, the Fed influences housing demand overall. When borrowing is cheap, more people buy homes, pushing up prices. Higher rates cool demand and can even lead to price corrections, which matter whether you're buying, selling, or renting. 9. Consumer confidence and spending. Fed policy affects how optimistic or cautious consumers feel. In times of uncertainty, rate hikes can make people hold back on spending, which affects businesses and potentially leads to layoffs, changing how confident you feel about your financial future. 10. Dollar strength and import prices. Fed rate changes also impact the value of the US dollar. A stronger dollar can make imported goods cheaper, helping consumers. A weaker dollar can raise prices on imports, contributing to inflation. Either way, your cost of living is directly tied to this dynamic. While the Fed might seem like a distant institution, its decisions impact your daily financial life more than you think. By understanding how Fed policy works, you can better position yourself to take advantage of economic changes rather than be surprised by them.